So let's talk about the upcoming stock market crash. Yeah, I said it, the upcoming very soon stock market crash. So let's go over the term asset inflation. And asset inflation is not the inflation of goods and services, but it's the inflation of things like stocks, bonds, mutual funds, and things of that such. So essentially, it's the inflation of the stock market and any assets that go along with that. And asset inflation also includes real estate. I wanted to go ahead and throw that in there. The last time we had asset inflation was in the early 2000s, and I do want to mention that in 1990 to 2000, well, that decade span, the stock market grew by 15% over the decade. Comparing it to now, the stock market has grown almost 14% over the past decade, which is about just 1% off of where it was when it was considered asset inflation. So this boom in the stock market is known as a bull market. It's a bullish market right now. So I'm using the things that happened in the past and comparing it to the situation we're having right now because it's very similar to each other. In the past, the history usually repeats itself. Now, back in that time, the Federal Reserve Chairman Greenspan was trying to warn the public that the stock market was overvalued and it was booming too much to where it would negatively affect the economy. But traders and big hedge fund companies and things like that and investors, they were like, please be quiet. Don't put that in the public. Don't put that in people's ears. Like, we want the stock market to keep going up because that's how we're making our money. So while traders and things like that were making their money and the rich and the wealthy were making their money, it was setting the scene for there to be a financial crisis. Now, this is very similar to the situation we have right now with the chairman of the Federal Reserve, Jerome Powell. He's like, no, I don't want to really cut these interest rates, but he's feeling forced to cut these interest rates because it's going to be good for the stock market and things like that. And it's going to help the traders and investors and the rich and the wealthy to make money at the cost of the economy. So instead of Greenspan hiring interest rates, making it more costly to be able to borrow money and to kind of put a halt on all the borrowing of money that was going on, especially people who really weren't going to be able to pay it back, which he knew, he just stood on the sidelines. It was like, okay, everybody's going to hate me if I raise these interest rates, and like basically everybody is against him. These high investors and these wealthy people are like, you better not raise these interest rates. So he didn't raise those interest rates. So this led to these companies just getting super greedy, including the banks like Citibank, Bank of America, things like that. All these really huge hedge fund companies, like they're just, giving out money, borrowing money, and all these things like that because they're really just not paying attention to any risk or not caring about the risk because they're thinking, okay, well, the Federal Reserve chairman will bail us out if anything goes wrong. And that's exactly what he had to do. So essentially the deal that the Federal Reserve made with the stock market was, okay, you can take on as much risk as you want to and borrow and lend out as much as you want to, and we'll come and save you by lowering your interest rates. And that's exactly what happened. And on top of that, they used taxpayer money to bail out these big corporations, these big banks that were taking on all these risks, and it was going wrong. It was going against them. And this is what led to, the start of the financial crisis, because you're using trillions of dollars of tax-paying dollars to bail out these hedge funds and these big companies for essentially being careless with money. So when he lowered those interest rates, it created a whole new type of problem, the housing market crash, because the interest rates were so low, people were borrowing money to get houses and things like that. And then when interest rates go back up, they're not able to afford it anymore, which goes to foreclosure and things like that. We're going to talk about that tomorrow, but I just wanted to show you how what happened in the past is literally happening right now. Like, Trump wants Jerome Powell to lower these interest rates, so basically we can have another market crash, so then we can build ourselves back up again. And that's what he meant when he said we're going to have to endure some pain before things can get great again. I don't know if y'all remember he said that in his speech when he got inaugurated, but that was what he said, and this is exactly what he meant by that. So do not think for a second that these interest rates are being lowered to help the economy or to help you, the everyday person. No, it's being used to help the wealthy in the stock market. And so I think you should really think about that when you're thinking about where you spend your money. And I guarantee to you that this is going to happen all over again, and the stock market is going to crash within the next few months, or by the early start of next year. It's going to crash, and a way to protect yourself is to get involved in the stock market and make money off of this crash. As these stocks are going down, put in those put options. All right, that's all I'm going to say. Have a wonderful day.